What interest rate do traders look at, and how does it affect the dollar? This is seemingly an elementary question, Paul, but it's a very important one, and one that can change. And honestly, as someone who started his career trading interest rate products, it took me a while to learn how this worked. I mean, I was slinging euro dollars and Treasury futures, cash treasuries, all this different stuff, and I didn't really understand how it worked at the time. So I think important to go through. When I say to you, before we dive into it, I know you've seen the slides, but rates are getting hammered. What does your mind go to first? What duration? What kind of product? What happens in your mind? What do you visualize?
I usually think about the 10-year rate, the 10-year yield. That's the one I will go to first, and then I might check the 2-year and the 30-year out, and then check FX to see what the kind of correlating move is. That's kind of where my mind goes. But yeah,
interesting. So yeah, that I think would be the case for a lot of people, is they would go to treasuries. Now, I will, especially given how relevant the Fed has been, not only in the last couple of months, but the last couple of years. I mean, it's rare, dude. The environment that we came out of college in, the Fed was
benign,
trivial. Like they didn't do anything, and that's not their fault. It's like, they didn't do anything because they had bad leadership, whatever. You can have opinions about that. But inflation was around 1 or 2% for year on end. Growth was solid, but whatever. And employment was solid, but whatever. In the last couple of years, we've had obviously a pandemic, some very, low employment and growth and everything else, prints, and then some of the highest of the last several years, and then face-ripping inflation prints. And so you have a Fed that hiked several times throughout 2022 and throughout 2023, up above 5%, which is the highest that I think we've seen in our lifetime, going back to it would be back to the 80s, I'm pretty sure. And so you've had a very active Fed. To your point, though, Paul, Treasury yields is probably where people go on a day-to-day basis for a good reason. We have up here on your top right, that is the Fed funds rate, which is an overnight rate set by the technically set by the FOMC, but members of the Federal Reserve at only a handful of meetings per year. I believe it's 10 meetings per year, though they can and have called emergency meetings. If you remember the pandemic, some emergency meetings to cut interest rates off of, I think they were only 1 or 2% at the time, but cutting them back to zero because of all of the craziness going on. But if you look at that 10-year chart, Paul, that's a much normal chart at your bottom right part of the screen. And that's because people trade 10-year cash treasury notes, 10-year note futures, at this point 10-year yield futures, so many different products on a daily basis that if something happens like non-farm on a Friday, and the Fed isn't obviously meeting on that same day, well, the Fed funds rate isn't going to move, but that Treasury yield is going to move. And so that's what you see quoted at the Wall Street Journal and everywhere else. And so you're probably right to, I think about that on a day-to-day basis, if that makes sense.
Yeah, it's a closely watched one. Everybody watches. The 10-year, the 2-10 spread is another kind of dynamic that a lot of traders watch. And this one, it has been normal for a lot of our lifetime, but obviously recently we talked about this, I think last week, about kind of the moves in Treasury. You're looking at a 50 basis point move in the last month in 10 years, which is a big move in 10 years. So that one, it could go anywhere from here, but it's definitely a closely watched one.
And some interesting stuff to kind of see here as well, which is that both of these interest rates have peaked in that end of 2024, start of 2025 range, or if you just want to say at some point in 2024, they both peaked, and they've both kind of moved lower off of those highs. And so interest rates in the US are going to tend to move in the same direction, but they can be higher or lower in different durations. Normally, you would have shorter term interest rates lower than longer term interest rates, but we've seen inverted yield curves in the past that we'll get to in just a second. But hanging on that Fed funds rate piece for a second, I don't want to make it seem like on a day-to-day basis nobody's looking at it and it's just like, oh, we're all trading treasuries until the next Fed meeting, and then it's just like a binary trade of like they will or they won't, because there are futures on these short-term interest rate products. They're not the most liquid, not the most traded by retail people, but they do give you an idea of what the market thinks the Fed will do going into an event. For example, the December futures that pair up with this short-term interest rate product are looking at right now a distribution of maybe 75 to 100 basis points lower than where we currently are at. And we look at this all the time, right?
Yeah. And we usually look at the kind of distribution, right? When we look out this far, because we're looking out 7 months. And if you have a crystal ball that can tell you what we're going to be in 7 months,
no clue.
Yeah. I mean, this is what this tells you is no clue, but likely lower, which I think is kind of where we've been. I mean, we've looked at this for years now. I mean, I think last year we were supposed to get 4 or 5 rate cuts, and I think we got 2.
I think we got 2 as well, yeah.
So
very much a moving target here, but I will now show you what the current targets are across those different central banks. And again, keep in mind that these tend to be round numbers. They tend to be binary movement, but everything from forex pairs to equities and everything else will move depending on, what was UK employment data? Okay, it was strong. Maybe they won't be cutting interest rates. And so though that overnight rate might not have technically moved, speculation on it will be moving, and asset classes that are tied to it will be moving. But yeah, I mean, you've got the Bank of England, the Fed, you've got the European Central Bank, every region here with a major central bank that is most directly going to affect the rollover rates, the overnight funding rates between your currency pairs. And so right now, a lot of people might look at that higher interest rate in the UK or the US from a forex perspective and want to be long that currency to get that positive carry over being short maybe a Japanese yen or a Swiss franc. So there are practical uses to this in more popular retail trading environments like forex. Like I say, not a lot of people trade those short-term interest rate products, but these overnight rates do technically affect a lot of these markets while also broadly having influence over equities and everything else.
Yeah, I mean, absolutely. I mean, when these interest rates move, when they change policy, that's where you see the kind of more exasperated moves in FX. Kind of the thing I'm looking at now is if the U.S. isn't going to be cutting rates, but everywhere else is cutting rates, how does that not mean a stronger dollar? I mean, all else being equal, that should mean a stronger dollar. There's more dynamics this year than there has been in the past. But this is kind of what I'm looking at, and I'm really going to want to be looking at the tape today, especially after the Fed kind of into the end of the week.
Because, the 10-year yields here, though they are, and I'll bounce back and forth really quickly, they look pretty similar, 4.5%. And these are numbers from yesterday. So in the same ballpark here. I mean, no central banks since I pulled these numbers have moved, major central banks have moved rates. And you see, 4.5% for the British 10-year, 4.5% for the overnight rate, 4.3% in the U.S. and Australia, both of those having overnight rates around there. So they tend to be similar, but this 10-year doesn't technically affect those forex trading dynamics. But they can, on a day-to-day basis, you can see, oh man, the 10-year yield just dropped 10 bips and in the U.S., and the U.S. dollar is down. And so you can monitor these things, like I say, when the central banks aren't technically moving. But I do want to end here because, to your point, Paul, there are so many other dynamics that are involved here. It's not just a theoretical, U.S. rates are up here and Japanese rates are down here. And if that gap widens, then the U.S. dollar goes up and to the right. And if that gap shrinks, then the U.S. dollar goes down and to the right. You've seen, some more instability in the U.S. and some of these trade talks and everything else kind of hurt that U.S. dollar. But if that gap stays this way and that instability leaves, then maybe there's some more US dollar strength to be had. If that gap closes with that instability, maybe there's more US dollar downside. But a lot of interest rates kind of the core of a lot of this stuff, but other dynamics included, right?
Yeah, of course. Yeah, obviously. And then there's just currency flows. If flows are going out of the dollar elsewhere, which I believe we've seen in some kind of emerging market Asian currencies we were talking about before the show. If you see that start to happen, you do see those currency pairs move, those prices move, especially when it's a very exasperated amount of currency that's moving out of the country.